MCQs for cost of capital. Can you take a PDF? Cost of capital, first question. It represents cost incurred for procurement of fund. A, cost of capital. B, cost of debt. C, cost of preference share. D, cost of equity. Procurement of fund is a combination. Therefore, it's called cost of capital. A is answer. Always dash the cost of capital is preferable. Higher, lower, medium, all of the above. Lower than cost of capital. Cost should be minimum. Next, cost of capital should be expressed in terms of rupees, times, percentage, any one of the above. Percentage, you have to express in, always you have to express in percentage. Which of the following statement is correct? Okay. A, cost of capital may be defined as the cutoff rate for determining estimated further cash proceeds of the project. B, to decide whether the project is worth undertaking or not. C, dividend is the cost of own fund and interest is the cost of borrowed fund. And D, all of the above. What is the answer? Answer is all of the above. All the statements are correct. Next. The new issue of security involved some expenditure in the form of underwriting commission or brokerage fee or legal or administrative charges are known as cost of capital, flotation cost, cost of debt, none of the above. While issuing, we are going to incur some expenses, issuing expenses. And the expense is parent tax. Flotation cost. Flotation cost. In class, we did the problem. Gross proceeds of issue, less issuing expenses. That expense they may give as a flotation cost. Are you able to follow? Good. Match it, particulars and the cost. KD, KP, KE, preference dividend, equity dividend, interest. KD represent what? Interest. Right? KP is for preference dividend. KE is for equity dividend. Therefore, for 1, 3, am I right? KD can interest and one sorry, A, B, C, A, B, C. For 1, C, 2, 2A, 2A, and 3, B. Therefore, which option is correct? Option C is the correct one. Okay. Next. Finding cost of debt issuing present value method is finding cost of debt using present value method is called cost of debt, YTM, CAPM, WAC. Answer is YTM. Yield to maturity method. Yield to maturity. YTM stands for. So that concept is called yield to maturity. Next. Which of the following is not correct with respect to YTM method, yield to maturity method? Not correct, they're asking. Okay. Cost of irredeemable debt is calculated by discounting relevant cash flow using IRR. That is not the correct one. Cost of redeemable debt only we can be in the position to calculate. B, YTM is the annual rate of investment from the current date till maturity date. So from the date of what investment to till the maturity dates. Therefore, that's the correct one. C, YTM is the internal rate of return at which current price of the debt equal to present value of all the cash flow. That is also correct statement. Last, it's a cost of debt using present value method. So B is correct, C is correct, D is correct. A alone is not correct because YTM is applicable for redeemable debt. Okay. Next. RV minus NP divided by N is called average liability, average premium, cost of debt, cost of preference shares. Average premium. Good. Which of the following not form part of computation of KE? Dividend price approach and earning price approach. Growth approach and realized yield approach. YTM approach, CAPM approach. YTM is not form part. So income approach is there, dividend approach is there, realized growth approach is there, realized yield approach, CAPM approach. These are all computation, various ways to computation of KE. Okay. YTM is for debt fund, not for KE. Next, dividend price plus growth approach is known as realized yield approach, CAPM approach, Gordon's model, earning price model. The answer is Gordon's model. Market specific risk under which a company operates is systematic risk, unsystematic risk. Market specific risk form part of systematic or unsystematic or no risk. The answer is what? Systematic risk. Which of the following statement is correct? A. Company specific risk as the risk is related with the company's performance is unsystematic risk. Second one, systematic risk cannot be eliminated by disinvestigation of security portfolio. C. Example for systematic risk includes inflation, government policy, interest rate, etc. Inflation, government policy, interest rate, etc. This is all form part of systematic risk. And the last one, AOE. The answer is what? All the statements are correct statement only. Therefore, AOE is the correct. Systematic risk includes inflation, government policies, interest rate, etc. Okay. 14th question. It represents opportunity cost of dividend foregone by the shareholders. KE, KD, KR, KP. Answer is what? KR. Cost of retaining. We did the problem. Why we have adjusted the tax? It's purely based on opportunity cost. Cost incurred for the shareholders. Therefore, KR represents opportunity cost of dividend foregone by the shareholders. If I paid the dividend, there is no retaining. Retaining is nothing but what? They are losing the dividend component. Are you able to follow? Next. It is defined as overall cost of capital computed by reference to proportion of each components of capital as a weight. CAPM, WACE, YTM, none of the above. WAC, weighted average cost of. Weighted average cost of capital represent what? Proportion of capital and the cost. That multiplication is called weighted average cost of capital. Next question. Sum of cost of individual component and proportion in capital is WAC, overall cost of capital, KO, AOA. All of the above. Overall cost of capital, nothing but weighted average cost of capital. Weighted average cost of capital, you have to express in terms of KO. Therefore, all the above. Are able to follow or not? Good. Usage of cheaper debt fund will dash the WAC. Increase, decrease, maintain the same, none of the above. Cheaper debt will. Weighted average cost of capital will get increase or decrease if I'm going to use cheaper rate of fund. Decrease. Lower the cost of capital is preferable. Weighted average cost of cost also represent cost. Minimization of cost by using the debt fund, overall cost will come down. Debt fund 18% back, some back வருது. Suppose instead of 18% loan, I am going for 14% loan. WAC will increase or decrease? decrease. Are you able to follow or not? Therefore, usage of cheaper debt fund will reduce the WACC overall cost. Are you with me? Next. The value of the firm will be dash at the point where WACC is dash. Option A, maximum, comma, minimum. Option B, minimum, comma, minimum. Option B, minimum, comma, minimum. Option C, maximum, comma, maximum. Option D, AOA. Answer is what? Value of the firm will be maximum at the point WACC will be minimum. Cost koranjada, value will get increased. Back if it get minimized, overall firm will get value will get maximized. Option A is the correct answer. Option B enna ponnum minimum. Option C maximum. Okay. Now WACC can be computed by way of book value, market value, any one of the above, all of the above. All the above. Both the methods possible. Okay. Dash won't arise in case of market value method. Which one is? Even what WACC can be computed by either by way of book value or by way of market value. So C may be the correct answer. Am I right or not? Previous one. Okay. Next. Dash won't arise in case of market value method of WACC. Which one is not arising? Cost of retained earning not arises in case of market value. Are you with me? Next. In general, KR is equal to dash. KE. Cost of retained earning is equal to cost of equity. When KR not equal to KE, when in case of corporate tax, in case of shareholders' personal tax, in case of no tax, any one of the above. Whenever shareholders' personal tax is there, KR not is equal to. So now we understood. After solving the problem, after learning the theory, it's easy or not? MCQ ஒன்னும் கிடையாது. படிச்சதும் திரும்ப வேற ரூபத்துல கேட்கும். If you learn properly, study properly, MCQ will be easy. Okay. Next. EPS into dividend payout ratio is equal to market price per share, dividend per share, company's growth, AOA. Dividend per share. Based on that, past exam questions also be solved. Am I right? Good. Share price rupees 100. Dividend payout ratio is 20%. Earning per share is 80. Find dividend per share.
16.
How come? EPS into dividend payout ratio is equal to DPS. 20% on 80 is equal to 16. Understand? Good. We did the problem, right? In case of which of the following is not an assumption of capital asset pricing model, CAPM model? The capital market is efficient. B, investor lend or borrow at the risk-free rate of return. C, investor do not have same expectation but the risk and return, about risk and return. And D, investor decisions are based on single time period. So which one is correct? Incorrect? Not an assumption. Clear? So what is the not an assumption? Investor do not have the same expectation. Is not correct. Everybody having the same expectation. That's the assumptions again. Assumptions in CAP. Next. Risk-free rate of return 5%. Market rate 10%. Cost of equity 15%. Value of beta is how much? So how to solve? CAPM model. Am I right? KE is equal to RF plus beta into RM minus RM. So we have to do filling the blanks. Risk-free rate of return how much? 5%. Market rate is how much? 10. Therefore, RM minus RF is equal to remaining 5%. Right? 10 minus 5. Okay. Then KE is equal to how much? 15%. What is the beta? 5% plus something into 5% is equal to 15%. What? 1.9, 1.8 to 2.2. Find out. Answer is 2. 2 into 5 is equal to 10. Am I right? 10 plus 5 is equal to 15. Therefore, answer is 1. C. 2 is the correct answer. Are you able to follow? Hello? You have to improve your calculation speed. Okay. Next. Dash may be defined as a cost of raising an additional rupee of capital. Marginal cost of capital, weighted average cost of capital, simple average cost of capital, liquid cost of capital. Marginal. Additional means marginal cost of capital. Which of the following cost of capital required to adjust tax? Cost of equity shares, cost of preference shares, cost of debentures, cost of retained earnings. Cost of debentures, we have to do. Tax benefit is that for debt fund. Are you able to follow? Next. Marginal cost of capital is a cost of additional revenue, additional fund, additional interest, none of the above. Additional fund. Cost of capital is itself for fund. Next. In order to calculate weighted average cost of capital, weights may be based on market value, target value, book value, any one of the above. Any one of the above. That's all. Yes. Next. Firm's cost of capital is the average cost of all source of fund, borrowings, all share capital, all borrowings and debentures, bonds and debentures, all source of. Clear? Good. A is the correct answer. The company has financial structure where equity is 70% of its total debt plus equity. Its cost of equity is 10% and the gross loan interest is 5%. Corporate tax paid is 30%. What is the weighted average cost of capital? So first column, source of fund. Here you go. Source of fund what? First column, kindly note it down. Source of fund. Under source of fund, equity and debt, one by one. Equity and debt. Second column, cost. Under cost column, equity how much? 10%. Interest, debt fund, 5 into 100 minus 30%. Right? I think what 70% on 5. How much 70% on 5? 70% on 5. 3.5. Multiple with the proportion. What about the proportion? 70% for equity, 30% for debt. So 10 into 70% plus 3.5 into 30% comes to 8.05 is the weighted average cost of capital. Right? Easy or not? In examination with less time, you can able to compute. Next. The cost of equity capital is all of the following. Cost of equity share capital is all of the following except A. The minimum rate that the firm should earn on the equity finance part of the investment. B. A return on equity finance portion of an investment that at worst level the market price of the stock unchanged. C. By far the most difficult component cost to estimate. And D. Generally lower than the before tax cost of capital. Lower than the before tax cost of capital. So what is the correct answer? Except, Leah. The answer is what? D. D is the correct answer. Next. What is the overall, that is weighted average cost of capital when the firm has 220 crores in long-term debt, 4 crores in preferred stock, and 16 crores in equity shares? The before tax cost for debt, preference stock, and equity capital are 8%, 9%, 15% respectively. Tax is 50%. Find the first column source of fund. In that source of fund, debt, preference shares, equity shares. Second column, cost 8%, 9%, 15% into 100 minus tax rate 50%. Are you able to follow? Third column, ratio 20 by 40, 4 by 40, 16 by 40. So multiply and find weighted average cost of capital. $20 by 40 into 8%, 4 by 40 into 9%, and 16 by 40 into 7.5%. Total comes to what is the answer? 8.9. D is the correct answer. Check. Got it or not? Understood? Able to follow? Good. Come.